Hey all, today I'm going to tell you how I bought my first Porsche at only 21 years old. I'm also going to break down how I financed the car and why I think that way is the best. So let's get into the video. In this video I'll be breaking down how much the car cost, the split between deposit and financing, the monthly cost for the vehicle, the difference between a bank loan, hire purchase, PCP and lease financing, and the difference and whether it's better to get a new or a used car. And if you stick to the end of the video, I'll show you how to get that monthly cost to rock bottom. But first, a bit of a backstory. I bought my first car at 17 years old for £3,000. It was a 2009 black Corsa. I'd saved all that money myself from my savings, birthday presents and bits and pieces like that. I then started an apprenticeship and was trying to save as much money as I could from each paycheck. See some of my other videos where I talk about and break down how you can save more from each paycheck. My next car, 2 years later, was a 2007 black Audi TT that I bought for £8,000. 2 years later again, I sold that car for £6,000 and bought a 2014 Porsche Cayman for £36,000. I put £12,000 down as a deposit and therefore £24,000 as the loan. The loan I got at a 5% interest rate, which cost me about £380 a month. And obviously I'll break down those figures later in the video and show you how I got that for such a low price each month. The first type of financing is a bank loan. This is an unsecured loan from the bank that's just taken out in any normal way that a regular loan is taken out. This has the advantage of it being quite flexible, and it's also at quite a low interest rate of 5%. It also has the advantage of being unsecured, which means that if you sell the car, you don't actually have to repay the loan. You can keep all the loan and just continue making that monthly payment, but the loan isn't tied to the vehicle. Another advantage of a bank loan is that you don't have to pay off the remaining interest, because interest is charged monthly. Let's say you take the loan out over 5 years, but you only intend to keep the car and the loan for 1 year. When you sell the car and repay the loan at the end of that first year, you only have to pay that first year of interest. You don't have to then pay the total interest amount over the remaining 4 years of the loan as well. A few other quick advantages of a bank loan are that firstly, the rates on new cars and used cars for interest rates are going to be the same. Because the bank loan is unsecured and not tied to the car itself, it doesn't matter whether you buy a new car or a used car, you're still going to get it at 5% interest. Another advantage is that bank loans can typically be taken out over a much longer period of time, for example up to 8 years instead of the standard 3 to 5 or maybe even 2 years. Additionally, because you actually purchase the vehicle outright, you own the vehicle from the start instead of renting the vehicle from the start and then owning it later. However, some downsides of a bank loan. The first one is that bank loans are typically capped, or unsecured bank loans are typically capped at 25k. Therefore, if you wanted to buy an even more expensive car, you'd have to get a second bank loan or maybe specialist financing that could be at a much higher rate of interest. And the second downside is that the best rates are often reserved for those people that don't take out the full 25k. For example, if you only take out 10 to 15k as a loan, you're probably going to be charged at a 3% interest rate, which is obviously even better than a 5% interest rate, but has the downside of not being able to get as nice of a car. Now, on to HP financing. What is HP financing? Well, HP stands for hire purchase, which effectively is just another name for spreading the total loan evenly over the life of the loan. So you're just making the same monthly payment each month. HP financing has a few upsides. Firstly, you're paying off a good amount of the interest each month, and therefore, in total, it's cheaper than a PCP deal. Also, there's no mileage restrictions that you have to stick to, unlike a PCP offer. HP financing has a few downsides. First off, it's typically a higher rate of interest. HP financing is between 7 to 10%. Also, there's a lot less flexibility in what you can do when it comes to repaying the loan. When you repay the loan, you have to sell the car at the same time. You can't sell the car and keep the loan, for example. Also, another downside is that the typical loan time for a HP finance is between 3 and 5 years. Therefore, the monthly payments are quite high, as obviously you have to clear the entire balance quite quickly, in only 3 years. Next up is PCP financing. PCP stands for Personal Contract Purchase. The main difference between this and a HP financing is that with personal contract purchasing, you effectively have an option of what you want to do at the end of the contract. You can give the car back with no penalty. You can purchase the car and do whatever you like with it as the contract's now finished. Or if there's any equity left in the financing, you can use that equity as a deposit on another car. Effectively, this equity is created where you are paying more each month than the depreciation that the car suffers. Therefore, at the end of the period, you've actually paid more than the car is worth. One of the main advantages of PCP financing is that the monthly payments are much lower than HP. However, the reason for this is because there's a big balloon payment at the end. With HP, the entire loan amount is spread evenly over the term. With PCP, about half of the loan is paid off during the term and the other half is saved as a balloon payment at the end. The interest on a PCP is kind of a double-edged sword. On new cars, you're much likely to get a lower rate of interest, such as even as low as 3%. However, on used cars, you're typically facing that higher interest rate of between 7 and 10%, which is obviously quite high. However, one of the main downsides with a PCP is that effectively, because you have different options of what you want to do at the end of the contract, you don't actually own the car from the start. You're effectively renting the car for that PCP period. There's a few downsides with renting the car, and the main one is that you're not responsible for what happens to the car. Therefore, if you damage it, you're most likely going to have to fix it and you won't have a say in that. Another downside is the way the interest actually incurs. Because that big balloon payment is being saved until the end, interest continues to occur on that big balloon payment, and therefore you incur a much higher amount of interest over the life of the contract. The final main downside to a PCP contract is that you've typically got fees or penalties if you go over the allowed mileage. Because you're renting the vehicle owner will typically only allow you to do between 5 and 10,000 miles a year. Anything more than that and they start charging you around 15 to 20 pence per mile. The last method is lease financing, typically called PCH or personal contract hire. This is effectively just a rental period. Usually leases are only over a period of 2 to 4 years and therefore a much shorter period than PCP, HP and bank loan financing. Lease financing can be quite advantageous because you have that lower monthly payment but you don't have that balloon payment to make at the end of the contract. However, there's less flexibility with lease financing because you can't buy the vehicle at the end of the contract and you have to give it back. There's never any form of ownership because you're only renting the vehicle. Some other downsides to lease financing is that it's only really available on new cars. You can't hire used cars. Also, there's a lot less customization. With PCP, HP and bank loans, you can effectively find the most perfect car for you or design the perfect car and then just finance it separately. With lease financing, typically you can only lease a base model car with no extras, no tips, no bells or no whistles. If you've enjoyed the video so far, leave a comment down below with any other questions you need answering or any other topics you'd like me to make a video on in the future. Next up is the topic of new versus used cars. Basically, used cars are always better from a financing or from a money perspective. Cars depreciate in a method which is called exponential decay. I'll show an image of what that looks like on screen. Effectively, what you can see is that there's a lot of depreciation at the very start, especially in that first and second year. With cars, the depreciation tends to bottom out around the third and fourth year. Taking this back to my example, a brand new 2019 2-litre turbo Porsche Cayman, which is the base model, goes for about £54,000 to £60,000. As you know, I bought my Porsche Cayman, which was 3 years old at the time, for £36,000. This means that there'd already been between £18,000 to £24,000 of depreciation in the first 3 years, which works out at around 6 to 8k depreciation per year. But obviously, as we know, the car depreciates more at the start, and therefore it's probably more likely 8 to 10k depreciation in the first and second year, and then somewhere between 4 and 6k depreciation in that third year. I sold my Porsche Cayman after the first year for 33k. This meant that I only lost around 3k in depreciation, which is obviously much better than 8 to 10k that the car loses in the first year. I sold my Cayman after 1 year because I said to myself that I only wanted to keep it for 1 year so that it didn't cost me too much, because obviously I was still making the monthly payment and also lost some on depreciation as well. Obviously, as you can tell from the exponential decay chart I showed earlier, it's even better to buy a car that's 4 or 5 years old because it's bottomed out even more and suffers less depreciation. However, cars that are 4 to 5 years old have typically run out of warranty by that time, and to fix a supercar or a sports car can be very, very expensive. Now, onto my secret tip for getting that monthly cost to rock bottom. The secret tip is that it's all about timing. On screen, I'll show a comparison between a PCP contract, a HP contract, and a bank loan over 3 years, and compare that to a bank loan over 7 or 8 years. As you can see, the monthly cost for a bank loan over 7 to 8 years is significantly lower than any of the other financing methods over a 3-year period. Now, some people might say, wait up Tom, hang on a second, you're going to have to pay that loan off over 7 years. Does that mean you have to keep the car for 7 whole years? What happens if you want to change cars after 3 years? Do you continue then paying a second loan at the same time as paying the first loan? Well, the answer is no. When you come to sell the car, you can pay off that loan and you'll keep most of, if not all of, your initial deposit. And I actually managed to keep pretty much all of the deposit because my monthly payments basically paid off that 3k that I lost. You can then go and buy a new car and take out a new loan if you wish. And obviously, you don't actually have to pay all of the interest off on that first loan. For example, if you sell the car after the first year, you only have to pay that first year's worth of interest. You don't have to pay the remaining 6 or 7 years of interest. If you want to continue learning about finance further, or even how to invest, then continue watching some of my other videos, subscribe to the channel and ding the notification button. That way you'll be notified when I upload a new video. Cheers.